Welcome to Kitco News. I'm Niels Christensen. We're seeing gold prices trying to push to the top of their range as investor sentiment starts to sour. Fears of a prolonged recovery weighing on investor sentiment today. Here to talk about gold in this environment of low interest rates and uncertainty is Chris Vecchio, Senior Currency Strategist at DailyFX.com. Thank you very much for joining us today, Chris. It's a pleasure to talk with you today.
Happy to be here, Neil. Thanks for having me.
So let's jump right into this. The Federal Reserve came out with their monetary policy decision yesterday. No major surprises. However, they are signaling that they're not raising rates until 2022. What do you think this does for gold prices right now?
Well, we have to think that this is a supportive policy for gold prices. Gold, silver, precious metals in particular, they don't offer a dividend, a coupon, any sort of payment back to the holder. And so if you simply are holding on to these precious metals, you pay storage costs. So there's a negative cost of carry. In an environment defined by low interest rates and what should be a rebound in inflation in the coming months as we move past the great lockdown and into the recovery phase of the coronavirus pandemic, that differential, that static interest rate held near zero, interest rates remaining low, coupled with rising inflation, will produce an environment of negative real yields. And historically speaking, when real yields turn negative, that's when gold and silver tend to do the best. If you reflect on the global financial crisis in 2008 and 2009, gold and silver actually didn't do well during those 2 years. They mostly moved sideways. The rally that we saw in precious metal prices came in 2009, late in the year, 2010, peaking in September 2011. And that was when we had that wall of central bank easing, low interest rates. We had inflation, but we weren't really moving away from that extraordinary monetary policy yet. So really, if we think about silver, for example, it has economic uses. It's used in creating LCD TVs. It's used in creating solar panels. We know that those type of energy sources, renewable energy, are in increasing demand as we move towards into the future. And so right now, silver to me is a fairly interesting prospect because if we do have greater economic growth, it will benefit in that regard. But two, we will see, in fact, that speculative flows go into the little brother, if you will, the two precious metals, and that tends to be the speculative vehicle of choice during a low interest rate, higher inflation environment. And Niels, it's really weird to say, but gold may very well take on its historical mythological role as an inflation hedge once more.
I guess we'll have to see. I mean, do you think the outlook the Federal Reserve gave yesterday is realistic? I mean, we have seen bond yields tick higher. You know, we saw the employment numbers come out. You know, people started feeling optimistic about a V recovery. Some of that's come off the table now as, you know, fears of a second wave of the coronavirus hits. But I'm sort of wondering, I mean, do you think it's realistic for the Fed to be able to keep rates at zero, or are they going to have to do more intervention, you know, looking out 2 years down the line?
I would first ask, what second wave? The United States never beat the first one. You take New York out of the equation, and the United States curve really isn't flattening all that much. In fact, heading into today, now 22 states are reporting their 7-day highs above their 7-day averages for new coronavirus cases, for hospitalization rates. These are steps in the wrong direction. What's particularly alarming is that Treasury Secretary Steve Mnuchin came out just today and said that there is really no political will in order to put us back into a lockdown. So we've now entered the phase where, unfortunately, because of the haphazard response thus far by the Trump administration, there's a little bit of confidence there, a lot of distrust that has been formed. And in an economy like this, you know, we need confidence and courage to get back on track. People need to know that when they go out to go grocery shopping or go to their job, that they're safe, and that even if this virus is out there, at least the steps are being taken to contain it, to ensure that things can go back to normal as quickly as possible. The United States simply isn't there. We don't have a widespread contact testing and tracing program just yet. And until we do so, people aren't going to have the confidence, in my opinion, to fully re-engage normalcy. And so what does this mean for the recovery? V-shape in the jobs, maybe if you look at a chart, but we still have lost about 20.5 million jobs in the economy, gaining 2.5 million jobs back in context of the fact that a lot of those are low-paid jobs working at restaurants, non-essential services, but minimum wage jobs. This isn't speaking to a robust recovery that's going to resume. And to that point, even so, the Federal Reserve is looking at 9.3% unemployment rate this year. That still means millions of people will be without work. It means that there's a lot of slack in the labor market. It means that the viability of the economy recovering quickly is drawn into question. Until we have the contact testing and tracing, we just won't get there. Furthermore, I think the real issue here is, well, the Fed knows this. The Fed knows this, which is why they're saying they're not going to raise rates until 2022. They see what's happening on the fiscal side of the equation, no different than when they make efforts to do QE, for example, because they see that fiscal stimulus is not arriving. So by saying rates will stay lower for longer, they are projecting an economy that is going to be sluggish, that's going to take a long time to get off the ground. Even if things turn up for a month or two or a few months, they may ignore it. If the economy recovers throughout the summer, there is still the fear that with the next flu season coinciding with coronavirus still making its way around the economy, we're going to see a much larger second wave. And a lot of those fears are based on what happened in 1918 with the Spanish flu, when cities like Philadelphia didn't properly shut down. And we saw that the Spanish flu really had its strong bite in the second half of the year. 5 million people or so died in the first half of the year, about 25 million in the second half of the year worldwide. So putting all these things together, even if we muddle through the next few months, even if things reopen up, even if things start getting back together, we come to the winter, the Fed is not going to be in a position where they feel confident that they'll be able to project what the spread of the virus will look like. So Fed's going to keep rates low for a long time, at least through this winter. And I think that's really good for gold and silver.
So, okay, obviously you're bullish long-term gold. We're at the top of the range. We've seen sort of gold struggle to really break out at this level. We've been stuck in this trading channel for 2 months. What do you think gets us out? Is it just time? Do we need to have a catalyst? Does another correction in equities give us the spark? What are you looking at?
So trading is not just a function of price, but it is a function of time as well. And so gold could stay at these prices for another week or two or month, but in about a month's time, we will start drifting outside of the sideways range that we've been carving out over the last several weeks. Since hitting that high in mid-April at 1747, gold prices really haven't done that much. But what's particularly encouraging is that during this time when gold prices have moved sideways and digested some of these, we'll call them overbought, oversaturated technical readings, we've seen gold volatility come down. Why does that matter here? Typically, gold volatility and gold prices go hand in hand. Unlike other asset classes, which don't like uncertainty, gold tends to benefit when there's more uncertainty in financial markets. So the fact of the matter is we've seen gold volatility come down about 80% from its closing highs that we had earlier this year, and yet gold prices have not. Now, over the past year and a half, when we've seen situations where gold prices have moved sideways and gold volatility's come down, it's been a precursor to a new rally. Gold is operating on this basis where higher volatility is good, lower volatility, neutral. And so we've started to see gold volatility turn the corner the last few days. That's encouraging. And we think, if you will, the market's now reloaded. They've digested the move. We've seen considerable time pass since new highs have been established. The stock market has been on an incredible run, and yet gold has stayed in this fight. One has to think that if things begin to sour, if we see this new data coming out suggesting more spread of a virus, gold looks like it has a fighting shot to break through and punch through 1747. So I think that from here, we'll watch this range, but in context of the fact that we did enter this range following a rally, technical analysis rules would tell us that typically when you enter a consolidation, the breakout move is in the direction of the preceding rally or decline. So bullish continuation is eyed here.
So how do you play this then? I mean, do you buy on the dips or do you wait for the breakout? Some people that I've talked to said, if you want to be frustrated, play the range. Maybe it's better to just play the breakout. Wait for that big push to really jump into the market.
Right. At this point in time, because we have seen such a significant sideways range develop over the last several weeks, my personal point of view is before looking to load into new positions, I'm waiting to see that this series of higher highs, if you will, resumes. I want to see the 1747 level punch through. That would be an acknowledgement that the market conditions have changed. I think it's difficult to argue that for the past 2 months, the market's been anything other than exuberant and bullish. You can see it in stocks. You can see it in the commodity currencies, Aussie, Kiwi, and the Canadian dollar. Heck, even oil is up out of negative territory. So when we take a look at the risk appetite picture, gold has stuck with it right now during what should have been a very difficult time. Declining volatility, surge in risk appetite. We're through that period now. We've made it through this storm. Gold prices, fundamentally speaking, now know that they have the Fed at their back. I do think that gold and silver here look as attractive as they've ever been in my limited experience over the past decade plus in this market.
I guess the last question I have you, I mean, obviously you're bullish on silver as well. What price levels are you looking at? What's your target for silver for year end?
So silver has been trying to work through this bottoming process for a few years now. Unlike gold prices, which really broke out of their sideways consolidation in May, June 2019, silver prices are still trying to climb their way out of these various descending triangle patterns. But the thing about this is we've made these breakdowns only to see returns into consolidations. Now, technically speaking, that's a sign that the market is, if you will, unloading a saturated position. Psychologically speaking, when we see prices make a breakout, return into a range, we typically see a move to the other side. So why does this matter here? We've seen silver prices sell off sharply, return back into the sideways ranges that we were attempting to bottom with. This would speak to the potential now that the market maybe has had a change of tune. We've now seen a psychological evolution. We're now looking for a more bullish set of price action moving forward. Given the fact that this has been a multi-year effort down here, I think you want to be a little bit more careful with silver. If we find ourselves back up at 15 or 16, which are much higher than where we are right now, we find ourselves trading through 15 or 16 through the summer months, that to me would be a very, very strong sign that this is a market that is taking the change in fundamentals very seriously. And moreover, nothing changes people's mind like price, right? So I do think that silver needs to ride this out and perhaps can benefit with gold going up. But silver, historically speaking, has tended to do well during these times of negative real yields. If it's 2008, 2009, or perhaps most famously, which of course concluded with the Hunt brothers issue, but the silver rally back in the 70s and early 80s. And of course, there's no two people cornering the market right now. The Hunt brothers have long been gone, but that type of environment where you have high inflation and relatively lower interest rates and negative real yields, it persists.
Thank you very much, Chris, for the market lesson and the history lesson. I really appreciate talking with you today.
Niels, it's always a pleasure.
Thank you for watching Kitco News. For the latest in the precious metals markets, go to kitco.com. Stay safe and stay healthy.